Thanks, Chris, and good morning, ladies and gentlemen. Firstly, I just want to point out that you should all have one of these in your packs. This does detail all of the budget announcements, and at the back has all of the rates and stuff for the coming year, so don't worry about trying to write everything down as we're talking this morning. So, it had already been announced that the personal allowance was increasing to £10,000 for the 2014-15 tax year. The Chancellor announced a further increase to £10,500 for the 15-16 tax year, which, given the increases to the personal allowance over recent years, was hardly surprising, to be honest. You can see on the slide there that the rate at which the personal allowance has been increasing recently is quite dramatic. And according to the government, this is designed to support those on low and middle incomes and reward work. The increased allowance will mean a basic rate taxpayer will see a saving of about £112 in 14-15 and a further £100 in 15-16. And the increase to 10.5 is expected to cost the government £1.4 billion. The government believe that this increase to 10,500 will actually remove 288,000 people from income tax altogether. And quite interestingly, 58% of those are women. The Chancellor also announced that the basic rate threshold will be reduced to 31,785 for the 15-16 year. And that's a reduction of 80 quid from that in 14-15. So, once you add on your personal allowance, that means that if your income goes over roughly 42,000, that's the point at which you start paying high rate tax. So I don't think the Chancellor mentioned this, but this is the movement in that threshold over the last few years. So you can see it was originally coming down, and then more recently it's going up. But the rate at which it's going up is nowhere near as fast as the personal allowance. And this is known as fiscal drag, or bracket creep, as I like to call it. So some of you might be wondering how many more people will be paying high rate tax compared to those 288,000 that will drop out altogether. Well, the answer is 1.1 million. Or 400,000 if you read the Daily Telegraph. Now, what I think is quite remarkable is that back in 1988, when the 40% rate first came in, only 1 in 20 people were paying income tax at 40%. And that's compared to 1 in 6 today. Now, apparently, Mr. Osborne recently said that ordinary voters liked paying 40% tax because it made them feel like a success. Now, I can't remember the last time one of my clients told me they liked paying tax at 40%. But there we go. So, most people have income which is made up of a mixture of earnings, so that's things like wages and pensions, and savings, so interest from banks, building societies. Last week, the Chancellor announced changes to the starting rate for savings. So the rate for the coming year is on screen there, 10% on the first 2,880 of savings. So if your earnings, once you add on your personal allowance, if your earnings are less than 12,880, then some or all of your savings will be taxed at 10%. From 15-16, the Chancellor announced that these rates are reducing to 0%, and that's on the first £5,000 of savings income. So this change will primarily benefit those with low overall incomes. So that's typically pensioners, part-time workers, and non-working adults, all of whom do have savings income over the personal allowances. So the government think that around 40% of those benefiting from this are expected to be pensioners like young Bruce there, 185,000 of whom, again, will be entirely removed from income tax. This is one of many announcements that was aimed at pensioners, and David's going to be telling you a little bit more about these later on. It seems to me that this change is going to add additional pressure on banks and building societies because a lot more people are going to be applying for their interest to be paid gross. So we'll see what happens there. So as Chris alluded to earlier on, in a move similar to last year, the night before the budget, the government did release information on the new childcare scheme. So first of all, I wanted to recap on the current scheme. It's a vouchers-based scheme, so the employer provides vouchers as a tax-free benefit to their employees. And those employees can then redeem those vouchers at registered childcare providers. The new scheme, which was originally announced the night before last year's budget, was to be phased in from the autumn of 15, and for childcare costs of up to £6,000 per year per child aged under 5, support of 20% would be given, so that's £1,200 per child. And the scheme would provide support for families where both parents are in work and they could earn up to £150,000 each. And it works via a childcare account, which again is redeemable at registered childcare providers. At the time, some of you might remember last year, we did raise concerns about whether this would or wouldn't apply to the self-employed. So, again, the night before this year's budget, some changes. The scheme will now apply to childcare costs of up to £10,000 per year per child, and that's aged under 12. And it's the same 20% relief, so a maximum of £2,000 per child. The government's consultation had originally proposed that the scheme would build up more gradually, and it would actually take 7 years for all children under 12 to become eligible to receive support. So that's quite a big change that now straight away children under 12 will be eligible, so that's quite good. For the first time, self-employed parents and those working for the vast majority of employers that don't offer the existing vouchers-based scheme will be able to access this support. And to give you a little bit of context, only 10% of the Howard Worth payroll clients actually offer childcare vouchers to their staff, 10%. It will be available to those working part-time due to a minimum earning threshold of £50 a week, and the rules will also be tailored to support entrepreneurs and self-employed who do not at first meet these minimum earnings requirements. I was doing some calculations with James, our payroll manager, yesterday, and it does seem that the old voucher system may still be better for you in certain circumstances. A basic rate taxpayer using the voucher scheme would get £2,860 per year in vouchers to spend on childcare, which equates to a tax saving of roughly £915. So to get this same saving under the new scheme, you would need to spend about £4,500 on childcare. So if you do spend less than this, and you are a basic rate taxpayer, then it might be better for you to continue to use the vouchers scheme. Following a recent consultation, the Chancellor also announced some changes to Class 2 national insurance and the way in which it's collected. It's currently paid by the self-employed, typically on a monthly basis by direct debit. The proposal is for it to be collected alongside Class 4 national insurance, so effectively via the self-assessment system, by a tax return. When the government consulted on this, many respondents actually argued that the scope of the consultation didn't go far enough and suggested more fundamental changes to national insurance for the self-employed. HMRC have said they'll consider these suggestions, so we could yet see some more changes in this area. The Chancellor announced a couple of consultations that will affect a couple of our clients who are non-UK residents. The first of which is a consultation on whether the personal allowance should or shouldn't apply or should or shouldn't be restricted, to UK residents or those living overseas that do have strong economic connections to the UK. And the second was whether or not to charge capital gains tax on gains made by non-residents on UK residential property. So we'll be keeping our eyes on this and the national insurance proposals, as it will, or it could potentially affect quite a number of our clients. So, an area which has been getting a lot of press attention lately is tax avoidance. We've been closely following this, as it is quite a thought-provoking topic, and we've been getting a number of questions from clients and professional contacts. The press, and to a certain extent the government, have been using the phrases tax avoidance and tax evasion interchangeably. So to be clear, tax avoidance is the interpretation of the legislation in a way in which Parliament perhaps didn't intend. And the key word here is interpretation. There's nothing illegal about it. Tax evasion, on the other hand, is illegal and might typically involve submitting false information to HMRC. The government don't like tax avoidance and have recently increased their efforts to put taxpayers off it. Historically, in order to prevent taxpayers exploiting loopholes, the legislation had to be rewritten each time a loophole was found. As you can imagine, this was a very time-consuming, expensive, and often fruitless exercise because as soon as the legislation was amended, somebody had found another loophole elsewhere. Taxpayers that had taken advantage of tax avoidance schemes often found themselves in long and drawn-out arguments with HMRC, which ultimately ended up in the courts deciding on whose interpretation of the legislation was indeed correct. So to combat this, last year saw the introduction of the General Anti-Abuse Rule, or the GAR, which is designed to deter taxpayers from entering into abusive arrangements. If a taxpayer then goes ahead with an abusive arrangement, the GAR operates to counteract any tax advantage achieved. So, unlike previously, this is more of a catch-all situation, rather than specific legislative changes to specific loopholes. So, moving on to the budget, following consultations that were actually announced in the autumn statement, the budget continued on this theme by announcing a proposal relating to the payment of this disputed tax. Now, often tax avoidance strategies result in the taxpayer reducing their tax bill and keeping their hands on the cash that would otherwise be paid in tax. HMRC, quite frankly, don't like this, so the proposal is for taxpayers who have sought tax advantages through disclosable schemes to pay the disputed tax upfront. So what's effectively going to happen is that if a taxpayer has an open inquiry, HMRC are going to send them a bill for the tax, and they'll have to pay the tax within 90 days. And this is known as an accelerated payment notice. Now, according to HMRC, they estimate that 33,000 individual taxpayers and 10,000 corporate taxpayers, worth 5.1 and 2.1 billion respectively in disputed tax, will be receiving these accelerated payment notices. Now, according to HMRC, the typical tax avoider is a man aged between 35 and 64 with an average income of £262,000. So from our discussions with those involved in the tax avoidance industry, there seems to be some doubt as to whether the proposals in their current form will actually make it into the legislation in the summer. And there are a couple of reasons for this. The first one, there is an element of retrospection in the proposals. The accelerated payment notices are going to be issued to all taxpayers who have an open inquiry at the date of royal assent, which is usually back end of July. This means that a taxpayer theoretically could have taken part in a scheme a number of years ago and now be asked to cough up the cash. Or to put it another way, as Chris said to me last week, if he bought a shirt from Marks & Spencer's in the 2000 sale, it'd be a little unfair for M&S to come back this year and say, hang on a minute, we've changed our minds, the sale was actually a pricing error, can you now give us the extra cash? So, retrospection. Secondly, the accelerated payment notices are likely to result in a large increase in demand for these open inquiries, open cases to be settled. Now, there's some doubt as to whether HMRC actually have the resources to do this, given that they've cut 37,000 jobs since 2005 and are planning to cut a further 10,000 by next year. And thirdly, it strikes me that the majority of people that take part in avoidance schemes are executives in the City of London, footballers and celebrities. Is it realistic that people like Wayne there still have the money to pay the tax? Or have they spent it on Lamborghinis and hair transplants? So, in an attempt to modernise and strengthen HMRC's power to recover debts, the government announced it would recover debts directly from taxpayers' bank and building society accounts. This direct recovery of debts will focus on taxpayers who owe at least £1,000 and have been contacted multiple times by HMRC to pay. Don't worry though, a minimum balance of £5,000 will be left in your accounts across all of your accounts, and that does include ISAs. And the government is planning to consult on this shortly. So we will be keeping a close eye on both the accelerated payment notices and this direct recovery of debts, as we can foresee them being somewhat watered down before Royal Assent in the summer. So with that, I'll hand you over to David Glaister, who's going to take you through some of the pension announcements.